Okay, hello and welcome to CryptoCFOs Water Cooler Wednesday. Today we're going to be doing a follow-up discussion. About a few months back, maybe 3 months back, we formed the FRC within the community, which is our FASB Response Coalition, which was meant to respond to FASB's proposed new rules for crypto assets. And just they were seeking comment on kind of from the community as to which direction they should go, and maybe if there should be distinctions between different types of crypto assets and things like NFTs and wrapped tokens, and whether we should adopt fair value accounting or all these a number of different questions. And today we're going to kind of recap what their board decided on and kind of discuss the implications of this and dive a little bit deeper into this. And today we have a very special guest with us today. We have Stacey Ferris, who kind of headlined the whole FRC within this CryptoCFOs community. So welcome, Stacey. Thanks for joining us.
Thanks, Taylor. I'm excited to walk through this with everyone and show you where we're headed. So I'm going to go ahead and share my screen. And let me just get that done up there. Okay, so this is the FASB board minutes. And the reason why I wanted to walk through the board meeting minutes with everyone is it's going to show us the vote split on a few different areas. Some things, not a big surprise. It's kind of what we expected, which is great. In other areas, they have pulled back and they're going more high level. They're certainly giving some freedom of interpretation. So we're going to walk through what all of those items are. And this is, by the way, the board meeting minutes are just basically saying, we've read everybody's comments and here's where we think we're going to go. And that's useful for kind of allowing the whole community to see the direction and to start to make some of those changes and implement things that are almost certainly going to be in the final standard. So kind of just starting at the top here, they went through and voted on these criteria for what defines a crypto asset. Most of this is not very surprising. It's going to meet the definition of intangible asset. Does not provide, and you'll notice the vote here was 5-2. Do not provide the asset holder with enforceable rights to or claims on underlying goods, services, or other assets. So this is probably excluding wrapped tokens still. They don't actually name wrapped tokens anywhere in here. So that's kind of a gray area, I'd say, at this point. And certainly there's a split in opinion. Some people say, yes, it's an enforceable claim. Other people say, nope, you're swapping it for, you're just completely swapping it for a different type of asset. So depends. DeFi synthetics might be outside of this category because DeFi synthetics are usually built with stocks or bond shares as the underlying asset. However, because stocks and bonds are typically, well, not bonds, but stocks certainly are accounted for as investments under fair value accounting usually. So you might find that even a DeFi synthetic, even if it has a stock or bond or another investment instrument, TradFi investment instrument underneath it, the accounting might still be fair value accounting, quite similar. And then another area where I was like, I feel like there's a little gray area is kind of like the one-to-one asset-backed stablecoins, where if the stablecoin issuer specifically says each token or each coin is redeemable for $1, or for whatever the asset fiat currency underlying it is. So potentially there's some gray area there. Finally on C, well, not finally, but next on C right here. Now if you go down and look at the paragraph right below it, they have decided to modify C to, instead of saying it's based on blockchain technology, but to say that these are assets that are created or reside on a distributed ledger based on technology that is similar to blockchain technology. which is an interesting distinction, and I'm not entirely sure where they're going with that. I think that they might be trying to make room to include private permission type coins, or CBDCs potentially, because some CBDCs are on blockchains and others are on like distributed ledger, which it's private, it's permissioned, it's sort of blockchain, but it's sort of not really. Even though they've said, like, based on technology that is similar to blockchain, I don't think by any means this is excluding the tokens or coins that are absolutely on a true distributed network like Bitcoin, Ethereum, Doge, etc. On D, E, and F are secured through cryptography, are fungible, and are not created or issued by the reporting entity or its related parties. And so now this is going to require more guidance on how does the creator or issuer account for the coin. We've discussed this. We think that probably it's going to be some kind of equity. It might be something else. But it is going to mean that an entity that is creating or issuing coins, it's going to require them to track its smart contract balances and its smart contracts activity, most likely, as part of its accounting. That is, I would say, for some issuers, it's going to be pretty relatively simple if they're just issuing one coin. But for, let's say, a DeFi platform where they're, or one of those platforms where they're actually hosting all of the liquidity pools, or taking assets and then issuing some kind of a token for that pool, potentially you get into some weird situations there in the DeFi space. And also in the DeFi space with that liquidity pool token, that token represents a claim on the underlying coins in the pool. So again, some gray area right there. DeFi they really haven't approached or gotten into DeFi. In my conversations with, even the AICPA and their digital asset working group was kind of like, DeFi is something that we just haven't even really tried to tackle yet because it's very complex. And part of that is like, you don't necessarily make an accounting standard or provide guidance when something is brand new in the market. Sometimes you kind of wait and see how the market plays out and whether something needs guidance or not, right? Is it going to last? Is it going to survive as a type of product? And is accounting guidance, specific accounting guidance, really needed for this area? So with DeFi, I think there's a lot of experimentation going on, and we're going to kind of see what direction really cements within that space. Then we move on to measurement.
It's a wait and see approach, right? And I think that they it makes sense to some degree, but also DeFi has been around for a little while, and I think that people are desperately. I think that what they want to see is where regulation goes first, and I think that there's a lot going on in the background with, like you mentioned, CBDCs as well. And so I think that there's, with regards to like the 1099 reporting as well, I think they want to make sure they're not stepping on any toes with how that shakes out. So it's kind of, they're in between a rock and a hard place a little bit, but also it's just a bit frustrating that they're, the thing that we most need guidance on, which is DeFi, they're not really kind of providing as much of it. Yeah.
I don't think you're going to get it anytime soon. I mean, we're going to have this standard, but I mean, think about the timelines here. Bitcoin is issued in 2009, right?
Yep.
And you get 5 years later, you get a tax guidance notice, right? 10 years after that, we finally get an accounting standard that doesn't even cover all types of digital assets. It just covers the most common ones that are commonly referred to as cryptocurrency, right?
Right.
So, the FASB moves slow, and fair enough, because they have to see kind of, what they do is very technical. It's very detailed. They have to see what kind of entities are going to use this. Does this matter for public companies, right? If it remains some kind of like private company startup kind of deal, then maybe it really doesn't matter, right? but it's when it moves into the public company space, because that's really what the FASB is most concerned about, right? Is the public company. That's where GAAP really, really matters. We all know that, small sole proprietorships and small companies and startups and so forth, they try a lot of things. And a lot of the DeFi companies are still in that startup space where they're not public. They're not getting audited financials. And so,
You heard it here first, guys. Stacey Ferris says that GAAP doesn't matter if you're a small
Oh my
business.
God, that's not what I'm saying. But but a lot of times it gets overlooked. They kind of do cash-based accounting.
Yeah. I'm just messing with you.
What matters for those small companies is like, how much cash do I have? How much cash am I generating? And they need their accounting done more on the cash basis more than they need it on an accrual basis, right?
Right.
Yeah. Okay. Moving right along. GAAP matters for everyone. Okay. Just for the record.
Yes.
Okay, so on measurement, they went with fair value, which is exactly what everyone expected them to do. And I think we're all pretty happy with that. Now, the board decided not to provide guidance on how to recognize costs to acquire crypto assets, such as commissions and other related transaction fees. Why does this matter? I was trying to ruminate on what was that one dissenting vote and why would this matter? And I think, and I wanted to ask you tax guys, do you usually include commissions and fees as part of the tax basis of the asset?
Yeah, you do normally. Correct me if I'm wrong, Brian, but I'm pretty sure you do, because it's like the cost of purchasing that asset, right? So yeah.
So I mean, here's where, like, it doesn't really matter on tiny little purchases where, hey, your fee is like $1 or something, right? It matters. And this will matter more for the large companies where they're purchasing, let's say, $1 million worth of Bitcoin, right? Or several hundred thousand. And
right.
with if you add those commissions and transactions fees in, you're going to have a higher tax basis, which is going to lower any, recognized unrealized gain or recognized gain whenever it happens, or realized gain. But from an accrual perspective, you wouldn't necessarily put that into the value of the asset, right? Because it's an expense. Mm-hmm. So I mean, there's some leeway here on how to value the asset. And so we might see people doing it both ways, or you could see people keeping, their accrual books where they call it an expense, but for tax purposes, they pull it in and make it part of the basis. And FASB is kind of saying we're not going to provide guidance on how to do that. So I think, honestly, this is an area where there's a lot of things about GAAP that are not necessarily clearly documented in GAAP. It's just a best practice of, well, this is just how the best way to do it. And it's kind of known across the accounting community. And I think this is probably going to be one of those areas where whatever people do the most is what you'll see kind of take hold as the general practice. And then they affirmed their decision not to include additional measurement guidance on the application of topic 820, which is fair value measurement for crypto assets. So illiquid altcoins, right? We had a big discussion about illiquid altcoins and the fact that based on the market depth and the tokenomics, that whatever your book value of that coin is not what you're actually going to realize when you sell it. And fair enough. I mean, I don't think any of us expected that they would take any of that information and put it into an actual accounting standard. But the fact that it's not in the accounting standard means that there's some really critical information here that a crypto accountant needs to be aware of and take into consideration under certain circumstances. When is it going to matter that that this entity is holding, let's say, a significant or a material amount of illiquid altcoins, and they've put that on their balance sheet at market value, or the cost to acquire, and then they have an unrealized gain or loss in there, right? When is that going to matter? It's going to matter in due diligence, M&A, right? When you're trying to value the company, other valuation circumstances like litigation, damages, etc. When you're using them as collateral to obtain a loan, right? You put them down as collateral, but in reality, they're not actually worth the book value. So keeping that in mind is crucial for a crypto accountant, just to remember that it's not going to be in the GAAP standard, but you still need to consider that.
Yeah.
Okay. So then we moved into presentation. And with presentation, they have affirmed a few different items here. So at a minimum, present the aggregate amount of crypto assets separately from other intangible assets. So having the digital assets line item. Presenting gains and losses on crypto assets in net income, and present those gains and losses separately from the income statement effects of other intangible assets. So you would have a line item of unrealized gain or realized gain, right? Again, they're not giving any guidance on whether you should put it above or below the line. So I think you're going to have companies putting unrealized or realized gain loss from digital assets, and it will be in its own separate line item, and it looks like it's going to be packed into net income. So above the line, right? This means that a smart question to ask is going to be, how is crypto associated with the core cash generating business? If you're trying to analyze a company or do some financial statement analysis for whatever reason, you want to ask yourself, is the crypto core to the cash generating activities? If this is a mining operation, if this is a DeFi operation, if this is an exchange, then it's core. Then that unrealized gain is truly part of the cash generating activity that results in net income, right? If, on the other hand, you have a company like, let's say, MicroStrategy or Tesla or someone else who they have some digital assets on the balance sheet, but it's not really, MicroStrategy at this point is basically a Bitcoin hedge fund. Okay. It's an unofficial Bitcoin hedge fund. You can basically invest in Bitcoin by buying their stock, because like over 80% of their assets are Bitcoin. And Michael Saylor, of course, is, all over the media as basically the prophet of Bitcoin. And if you take out the crypto related line items from their financials, it paints a completely different picture of what is the underlying cash generating part of their business, which is producing those KPI dashboards, right? Now you could say, well, the Bitcoin has a big gain on it, and so therefore that's going to produce like, cash too if they sold the Bitcoin, and fair enough, it would. But then again, you have to ask yourself, well, is the company selling this periodically? And when they sell it, what are they selling it for? Are they selling it to get capital to invest? Why are they doing that, right? So just being smart about it when you see those line items in a company's balance sheet, understanding the role it plays and whether or not you need to remove those line items in order to really analyze the company performance, right? MicroStrategy has recognized a lot of impairment losses that they're about to reverse, right? And I think that we're going to see them recognize and put into their retained earnings. They're going to have a one-time adjustment that is probably going to be really large, in the neighborhood of $1 billion potentially. Depends on how they play that out. Maybe they're going to do it one time. Maybe they're going to split it up or something. I don't know. The effect of that, like because of the impairment charges that they were putting on their balance sheet in 2021 was the last time I analyzed their financials, right? I haven't looked at their 22 financials yet, but in 21, that resulted in like nearly a $1 billion loss. Okay, 22, I think they recognized some more impairments. They bought more Bitcoin in 22, recognized some more impairments, and now they're going to have to be reversing all of that to then bring it up to original book value, like the cost to acquire it, plus an unrealized, which the cost to acquire it to reverse those impairment charges, that'll go into retained earnings. Plus you're going to have the unrealized gain in there. So you're going to see like this big swing from being really negative on net income to suddenly being really positive, right? And quite high, perhaps. Obviously, the final end result depends on a lot of different things. Now, if you receive crypto and you nearly immediately put it into cash, then you can classify this as operating cash flows. They did note that for nonprofit organizations, if you are receiving crypto assets and if you are nearly immediately liquidating them, that these would be classified as financing activities, not operating cash flows.
Makes sense.
Right, makes sense. They decided not to provide incremental guidance on whether to classify crypto assets as current or non-current assets in a classified balance sheet. And they decided not to provide additional guidance on the presentation of gains and losses from crypto assets in the income statement. So you have a lot of leeway here. There's a lot of freedom to kind of interpret, all right. And I've seen some companies, there was a mining company that we looked at where they were splitting it between current and non-current. And that really is going to depend on the entity and how they want to put it together. I mean, if they're buying the crypto for the purpose of holding it long-term, then maybe it goes into non-current. If they're doing a lot of more like a lot of trading, right? Then, or they're receiving the crypto nearly immediately, putting it into cash or holding it for a short period of time, less than a year, and then putting it into cash. Maybe most of this goes into current. Again, depends on the company. And then how you present those gains and losses, whether you put them above the line or below the line, they're not providing guidance on that, right? I think a lot of companies are probably going to end up putting it above the line, particularly. I mean, it kind of depends on the company and how they want to do it. But one thing to pay attention to if you're looking at multiple years is like, do they put it above or below the line? Why? What would be the rationale, particularly when crypto is not part of the cash generating activity of the business, right? How are they putting that unrealized gain or loss into their financials, and what is the effect of it? Okay, then we move into disclosure, final section here. And so they've said that at both annual and interim periods, that information about significant crypto asset holdings needs to be recorded and disclosed. So for most companies, interim is going to mean quarterly. That you're going to need to disclose the name, the fair value, the units held, the cost basis. And then all of the other crypto asset holdings can be aggregated. The non-significant can be aggregated into a single line item. Significant crypto asset holding as determined by the fair value of that holding. That means generally in the past, if you go and look at other places where FASB or GAAP has used the word significant, generally it means about 10%. So you could use that as just kind of a rule of thumb of approximately like if 10% or more of my total crypto assets are in a specific one, then I need to disclose that one separately. One thing that will be useful to do is take a look at the significant crypto assets, look at the totals that they report, and then look at that as a percent of the total holdings. Sorry, I didn't quite say that right. What I'm trying to get at is the aggregate all the other crypto assets that aren't significant. It still is worth your while to take a look at what's the total of those other aggregated crypto assets. What percent is that of the total crypto assets? Why is that important? Because a lot of those other not significant crypto asset holdings are more likely to be illiquid altcoins. Okay, so from I'm looking at this company under due diligence, M&A, valuation, forensics, audit, any of that, I'm going to say, how much do I have in these other coins? And then potentially I'm going to do more inquiry or ask a few more questions about that. Well, can you give me a list of the types of coins you have in here? And then I might, go and look at those coins on the market and see what's in there, and do I think that some of these might be illiquid, or something to that effect. And that's just part of a smart financial analysis of the crypto assets that you find on a balance sheet. If you have crypto assets that are restricted from sale, you will have to always disclose the nature and remaining duration of the restriction and circumstances that could cause a lapse in the restrictions. This is most important for exchanges and anyone who is custodying customers' crypto assets. That's a little bit of a tongue twister. Custodying customers' crypto assets. And so that's just a note on 10% typically means that, and to do that little analysis of what are the not significant crypto asset holdings. Okay. They then affirmed the proposed requirement that an entity disclose at annual periods a reconciliation. They noted that you do not need to include activity related to crypto assets received as non-cash consideration in the ordinary course of business and converted nearly immediately into cash in that disclosure. Now, we discussed this reconciliation. How frequently does it need to happen, right? And it's possible for a high volume entity. You may say, let's do this reconciliation monthly. If you get to the point where you got to do the reconciliation on a weekly basis, then potentially you need to look at your accounting procedures and processes and see if you can find some, economies of scale or some more effective or efficient ways of being able to keep up with this so that it's compliant, right? And you're able to produce the reconciliation. From a business process perspective, this reconciliation should be something that is relatively easily supported with your accounting records, right? And so, with all, and there's a lot of focus on this with the FP&A type accountants that you want your close period to not be a really long period. So when you're trying to implement this new standard, trying to make sure that you do this in an efficient way to support month-end close, quarterly closes, and annual close. So interestingly enough, if you are taking a crypto, I was thinking about this, if you take a crypto asset and you nearly immediately convert it into cash, right? And I was thinking, well, I know that a lot of crypto Web3 type businesses have not been going from, let's say they receive some kind of fungible crypto asset, Ethereum or Ether or something like that. And a lot of them actually go into stable coins instead of cash. And it could be due to the ease of transfer, or maybe you want to put it into a stable coin for a period of time. You don't want to necessarily put it into fiat because you're still going to use it within that Web3 ecosystem, or you have employees, let's say, that prefer to be paid in that, or there's a lot of different business reasons why they might do that. So right now, the only thing that would qualify here is if you take your crypto assets and you turn them into fiat cash. However, you might be able to exclude from the reconciliation down the road. Cash could include CBDCs. It could potentially, not right now, but maybe down the road, it will include some stable coins. And that would be fantastic, right? Because that's going to greatly simplify, it would simplify operations, right? If you don't necessarily have to convert immediately to cash in order to, adjust this reconciliation. And I noticed that the vote was 5-2 on this as well. And so trying to determine why was the vote 5-2 on that? But there's not much clarity on why these two people were dissenting and what they disagreed with. On transition, they have basically affirmed that you just need to make one cumulative effect adjustment to the opening balance of retained earnings. That's it. There would be some kind of a disclosure around that opening balance, but for early effective date and early adoption, we are looking at a year and a half from now, December 15th, 2024. for fiscal years, and note this is fiscal years beginning after December 15th, 2024. So that means if your fiscal year begins on January 1, 2025, that's when you have to start implementing this standard. So it gives some leeway, right? It means that, let's say if your fiscal year starts on December 1, 2024, you aren't actually going to be required to be compliant with this standard until December 1, 2025, right? And then that's it. That's what they have basically affirmed at this point. A lot of things that we expected, some different items on there. And I'd say overall, they're kind of punting on providing some specifics in certain areas. And fair enough, like we said, the market kind of plays that out and shows us what's going to stick and what's not. Thoughts, questions? Thank you, Ari.
Yeah, I mean, again, we're always hoping for more clarity, and I think that, DeFi still has a lot of, regulatory muckiness to it. I mean, especially, I want to do a CPE course on like LP accounting soon, because I feel like there's a lot of challenges with that, and just, ultimately it would be nice to have everything wrapped up nicely with a bow, but I don't think there really is a way for them to do that because it's so complex. And I think that the understanding of it is limited in these venues, right? Like, I don't know how much FASB really has their finger on the pulse. I doubt there are any DeFi degens on the board. So they're probably not trading altcoins, or providing liquidity anywhere. So, as many of us are aware, you really have to get your hands dirty in DeFi to really truly understand it. So I think, I think that's going to be the biggest challenge with getting more clarity as well.
Well, some of those DeFi platforms and the entities that are actually like Aave or something like that. Is it Aave or Aave? I can never decide.
I say Aave. I don't know how it's
Aave. Okay, we'll go with Aave. But like Aave or something like that, where they're providing the liquidity pools, they might end up being classified as broker dealers, right? Which means your accounting changes if that's the case. So, with respect to DeFi, probably waiting on some regulatory clarity, right?
Yeah, and I think, and I mean, if they are considered a broker dealer, then Uniswap is too, and then I think Etherscan would be too. So I think I think part of the reason why they're punting is because if the broker regs go through as proposed, it's kind of a moot point because U.S. citizens wouldn't really be able to use DeFi anyways. They would be effectively geo-locked out of all of these things because there's no way for Aave or Uniswap or Etherscan to comply realistically without completely changing the nature of the tools, because really all they're providing is code, and they're providing an interface for you to interact with the blockchain in a way. And so I think you're right. I think that part of the broker dealer regs is one of the reasons why they're not making any further kind of formula.
Maybe we get a new we all have said this. Well, maybe we'll get a new category, but regulations has kind of shown that they don't like making new categories.
Right.
But a DeFi broker dealer or something like that, so that you could then adjust and say, if you are a DeFi broker dealer because of the nature of your operation. But that's kind of wishful thinking. Okay, his wife may be giving birth at this moment.
I think it was the
dog. Sorry, my dog.
The dog's warning him that the wife's going into labor.
No labor. My dog was just, someone's on the wall outside, and she was going nuts because she thought someone was breaking into her house or something. So.
When's the big day?
Well, I mean, the due date was yesterday, so we're like hoping it's any moment now. Really, it's
wow, that's exciting, man.
Yeah, my wife sure as hell is ready to push the baby out. I was telling these guys she's close to 9 pounds now, and my son was, I think, like 7 pounds 11 ounces. So my wife is like, doesn't want to wait another week or anything like that. She's ready to start whenever. So
Ready to
Yeah.
go. Great.
Thank you very much for that, Stacey. That was awesome. Really appreciate your insights on this. You're our resident financial accounting expert, and if anyone needs any help with forensic accounting either, Stacey is your lady. So yeah, thank you again for that update, and thank you for headlining the FASB Response Coalition within the community as well. We really appreciated that. So
yeah, absolutely. I've been teaming up with Amber Welch to help provide accounting reviews for startups.
Cool.
So it's a flat fee, fixed fee to make it affordable and predictable. And it's just a review that we go through your accounting records and we give you we tell you, hey, you look good here, and here's a gap, here's an area, risk area, here's a recommendation for what you could do for that. So I've been talking to, actually even got a call this morning from one of the startups that I advised in an accelerator asking for exactly that. And I said, oh my gosh, as it happens, that's exactly what we're doing.
Perfect. That's cool. Yeah, and Amber Welch she just started her own firm, right? She just I think she was with Crypto, something like that.
Yeah, she was kind of contracting with them just to help them address a few gaps, and she's already got like several large clients, and I mean she's just off, but she's real sharp. She's great. Yeah.
Awesome. Well, thank you for that, and yeah, if anyone's clients need those types of services, Stacey can help you with that. So. Thank you again, and we'll meet next week on some new stuff as well. So I'll announce the topic in the next few days. So if anyone has any suggestions for topics or anything they want to go deeper onto, please let me know. I'm happy to talk about whatever. So yeah,
more DeFi.
Yeah. Okay. Cool. I love DeFi. Let's do it.
Yeah.
And just a quick update. We finished the trip around the Cryptoverse course. It's officially done. We're just reviewing everything, making some final adjustments. We're hoping to have that out within 4, 5, 6 weeks max. So I know that's been a big thing, and it's kind of why we've been running a little slow content creation wise on this side. But we're happy to say that that's done. That's going to be at least a 3-hour CPE project. It's basically going to take you guys from step 0 all the way up to basically reconciliation phase. So we're excited for that. There'll be more information. And that'll be available for all community members free of charge. So that'll be something you guys want to jump on as well. So got a lot of cool things coming.
Sounds good. And welcome to Ari. He just joined. And so
Yes.
welcome there. Thanks for joining the community. Thanks for joining the discussion. And excited to have everyone here and excited to pave the way forward. So just a reminder to anyone, I created a document in the community about our discussion a couple of weeks ago when we were addressing some of the proposed broker regs, like we talked about on this call as well. So if you want to take a look at that shared Google Doc, I'll relink the post, but would like to have anyone else's feedback on that, and then we could submit it to hopefully get our voice heard and maybe shape the future of DeFi, because the way that they're currently worded, as I alluded to before, basically would shut out U.S. citizens from participating in DeFi. So we want to make sure that some of those concerns are addressed. So anyways, thank you everyone for joining the call, and we'll see you next week.